Welcome back again. This is part 2 of the worksheet on directors' duties. Now let's just go back to the place we left off, which was the section called reckless trading. Now this is one of the major sections we look at in the Companies Act for directors' duties. So we'll flick through it. We've covered 133. 134 was to comply with the Constitution. Now, 135, reckless trading. It's a straightforward section. Often referred to as insolvent trading, which is what it was referred to in the previous companies law, and it's similar. So reckless trading is where a director agrees to the business being carried on in a manner likely to create a substantial risk of serious loss to the company's creditors. Or the second one, cause or allow. So that's the director who sits back and does nothing when the decision's being made. Voting against it is not to cause and allow. So really you need to vote for or against. So what does it mean to allow it or cause it or agree to it being carried on in a manner likely to create a substantial risk? So it's likely. So it's a situation where there is a probability that the decision you've made will cause a risk to your creditors. The obvious one here is when the company's insolvent. So if the company is insolvent and won't have the money to pay its creditors when they fall due, then that is clearly reckless trading. Now if we go to the worksheet itself, this just restates the opening point and asks you to look at the difference between the two areas of agreeing and causing. And what you need to think is, well, what does this mean for me if I'm a director sitting in a board meeting and we are making a decision on buying some assets or entering a contract to deliver when we do not really have the money or the resources to carry out that obligation? What this leads to is, when is there a substantial risk of not paying? Now, not paying means not having the money when it's due. And that could be because you simply have no profit in the business, that you don't have sufficient financial resources, that you don't have an overdraft facility with the bank. And that's a matter of budgeting, cash flow spreadsheeting, and knowing that you can pay. How does it relate to the solvency of the company? Because not paying is a solvency question. Company is solvent if it can pay its debts as they fall due. Now, this example is asking you to consider whether this is reckless trading. However, it does have an overlap here, because what it says is the director Ted has bought himself some cheap software in Bangkok for 20 bucks. He gets Great Plains Accounting, which costs thousands. It's defective software, it crashes, so they really don't know the true position. Now that is most definitely a possible breach of section 300, because the accounting system or accounting records do not allow the company to make proper decisions. So you could address this in terms of 300, but you're being asked to consider reckless trading, and it's certainly a contributing factor. So over the last 12 months, lots of problems, borrowed money, the company's insolvent. So we know it's insolvent from the facts. And he enters into contracts to build and maintain rock gardens for commercial premises at very low prices. Now, there's a number of issues in this. If we say, has he allowed or caused the business or agreed to the business carrying on in a manner likely to create a risk, there are several issues. The lack of accounting software means there is a serious risk that the financial data is incorrect. The low prices create a financial risk, and combined with the fact the company is currently insolvent and that future contracts will not deliver increased solvency, this is very much a scenario which is highly likely to lead to risks to creditors. So I think we can safely conclude it's reckless trading. Now, a very similar issue arises in section 136. And this, which is straight from the section itself, the director must not agree to the company incurring an obligation unless the director believes on reasonable grounds the company will be able to perform the obligation when it's required to do so. So this is very similar to 135, except it's about taking on things, business, contracts, obligation, and having made a proper decision with proper information that a reasonable director would make and decide to go ahead. So Notice also it says on reasonable grounds. So it really talks about an objective test of would the reasonable director do this. So have I done proper planning? Have I made proper investigation of all the issues? Have I sought the advice if I don't have internal expertise on the area? What's an obligation? Does include debts, contracts, supply, purchase, manufacturing new products or service. Well, an obligation is where you have to do something. So do these things require you to do something? It's that simple test. So let's consider, is there a breach in this situation? So going back to our friend Ted, who's going to build a large Japanese garden for a company. 2 hectares, 1,000 tons of rock plus native New Zealand plants. Huge. So it's beyond anything the company's entered before, and so they employ Percy. And Percy provides references to show he's a gardener and got all the experience, but Ted doesn't check the references. He's only just completed an online free landscaping course and only ever worked on his parents' garden. So Percy has somewhat overstated his abilities. The question is Ted in breach of Section 136? So at the time of entering the contract to build this huge landscape garden in Japanese style, does he have reasonable grounds to believe the company will be able to perform the obligation when it's required to do so? Now, in the absence of prior experience to prove it, you would have to show that you've gone through proper planning and sought proper advice if you didn't have it internally. The size of this contract in relation to their existing business would suggest this is well beyond their capability and they have taken on a substantial obligation without reasonable grounds. So work through that, answering those questions, and we'll come back to it also in the defence. Now, director's duty of care, this is a very straightforward one, that a director should exercise reasonable care, diligence and skill. It's an objective test, so how much skill and diligence is required depends on the nature of the company, nature of the decision, and position of the director. So if it's a large company with significant financial issues and borrowings, etc., then it's going to import quite a high standard. So it's very much a moving scale depending on the size of the business, the risks involved, the expertise, the specialization. What this tells us is don't take on the role of the director when you don't know what you're doing. You should not be trying to learn on the job. So here we have an example. Accountant's director of a company, and he's asked to advise on export issues for a new product with a biodegradable bottle. And the customers are in Europe for this product. They manufacture it, and it's stopped at the border because if you read through the facts, EU has what are called waste directives, and these waste directives specify certain things to do with recycling, and they don't mix waste streams. The rules are not that obscure in reality, but they will result in such products being returned at the border. Even though they appear to be biodegradable, they still don't comply with the EU waste rules. So the accountant's never heard of this. Is he in breach of Section 137? Now, the problem is he's taken on a responsibility and a substantial contract. So you take in the nature of the company. Okay, it's an exporting company, so we need export knowledge. The nature of the decision relates to biodegradable products and recycling in another market, and the position of the director and responsibilities undertaken by him. So he's undertaken this obligation without the proper understanding or knowledge. So in those circumstances, we can argue that this accountant is in breach of the duty of care, diligence and skill, because a reasonable director would have the knowledge in export and in sustainability, or would seek expert advice. Now the defence we look at in here is Section 138, and it's a really good section. All it really says is we can rely on competent people in making our decisions. So we'll go through to 138. Here it is, use of information and advice. A director of a company, when exercising the powers and duties, may rely on the reports, statements, and financial data prepared or supplied and on professional or expert advice given by any one of the following persons. So this is our defense. So this accountant would have had a good defense if he had have actually sought the advice of an exporter. If the exporter got it wrong, the accountant would actually be safe. So we can rely on employees. We can rely on professional advisors. The qualification is we must believe on reasonable grounds they're reliable and competent. Right. And in the second one, to be within the person's professional expert competence. So you've got to make proper inquiry. And down here it states that the directors get this defence if they act in good faith, so it's honest. They make the proper inquiry where it's indicated by the circumstances. So should we check them out? Has no knowledge the reliance is unwarranted. If I need to do a solvency test for a company before distributing to shareholders, and I get the advice of KPMG, the accounting firm, I don't need to make inquiry. So it's not indicated. I can rely on them. Okay, and here we have Stan, the examples. Here asking the question, should the directors have relied on Stan in making their decisions? This example about Percy, which we had before, Percy had only done the free and online landscaping course. Did Ted make adequate inquiry in the circumstances? And you can decide whether you think that's correct or not. Section 300 we've mentioned earlier, what accounting records must be kept. That was in the previous worksheet. So what you need to do in section 300 is to go through there and look at the criteria which relate to whether the failure to keep records has contributed to the failure of the company or impeded the liquidation of the company, and whether you might get sued for that. So again, with Ted and his software, is he in breach of section 300? Was the software adequate to meet the requirements of section 194? We'll assume it's a small company. Did it show the financial position? Did it give him enough information to act reasonably? And I think we can conclude it didn't. Relying on pirated software that crashes all the time is not taking adequate steps to ensure the company can record its transactions, nor is it sufficient to justify the decisions under section 135 or 136.